Wake up, buyer payer people. It's a beautiful day. Go grab yourself another cup of joe and say hello to Jim and Michelle Rhoads on the Buy Here Pay Here Morning Show. Take it away, you two.
Hey,
Good morning.
We did it, hon.
We did it.
We made it to Friday.
Oh, wow.
Yeah, we did. Good morning, all.
Well, just so y'all know, too, today is the anniversary of our second date.
Yeah, that's true.
It
Yeah,
is.
the
I mean,
things we
it's
keep
not
up
as
with.
exciting as the first date.
Yeah.
First date was just drinks. Second date was dinner. We closed the restaurant down and
Yeah.
just talked and talked and talked and talked. So today is that day. And yeah. So got a couple of things. You know, I've mentioned this quite a bit. This is Carla F&I Legal Desk Book, 9th edition from our friends at Hudson Cook.
You know, maybe if you show that enough, people will start to get the idea that, hey, if I send in some koozies or some mouse pads.
Well, and I this morning I was like looking through Facebook and I saw Darla Boer was reading this.
Oh wow, okay.
On her flight, and
nice.
Terry McCauley, wrote in and he's like, "Hey, Steve Levine." And so I wanted to give a shout out for this too, because and actually this is more this is Winning the Fight, a guide to protect car dealers. And so those of you who know Steve Levine, he's from Ignite. He is another law firm attorney for dealers. This one is more stories and insight, and there's a lot of stuff in here that's Steve has been very active in writing in a lot of the publications, and so there's a lot of pieces in here from writing that he's done and referencing. So this is more of just a straight reference book.
Okay.
So if you want a good reference book, great one, Carla F&I Legal Desk Book from friends at Hudson Cook. If you want to read some things about insights and stories and whys, this is a great companion. So Winning the Fight, a guide to protect car dealers.
Look at Michelle. She's starting to become a book critic.
Well, here's the thing though, and this is our legal friends need as much help as they can too, because it's just such a dry subject.
That's a good point.
And it's so important that dealers are paying attention to the things. And I remember the first time I sat in on, I think it was Richard with Ignite that was speaking about, it's the first time that I heard something from Ignite, but he was talking about truth in advertising and all of that. And it was, it's dry subject, but for me, I'm like, I get this. This is the kind of stuff that, I don't know about you, but I was brought up in a family that rules were lifeblood.
Oh wow.
But so I understand how rules and things like that can help protect you. And so, and one of the things that we see an awful lot, especially with our viewers, we talk about the golden 500, we talk about the silver 5,000, we talk about the bronze 10,000, and that's basically the golden 500. They're the ones that come to all the conferences, and so they're hearing this stuff all the time. And we just, because of what we do, have the privilege of being able to reach a lot of people outside of that. And so plug. If you aren't familiar with a lot of the legal stuff, it's important. So good morning, Karen.
Karen Barnett.
Yeah, looking forward to today's broadcast.
So I grew up differently than Michelle. I have a lot of rules. I remember 2 rules. I grew up on a farm and ranch in western Oklahoma, and really just 2 rules for me. One was don't play with rattlesnakes. And the other one was don't let your little brother play with rattlesnakes.
Well,
that was about it.
There was actually one other rule, because you were telling me about it this morning. He's like, I remember my dad, the angriest I've ever seen him is I was home, thought I was home alone, listening to the Police.
Yeah,
it wasn't it was
do
you remember the Police? That was before it was now Sting. It's kind of and totally cranked up, but his dad just comes in and he's in the middle of a business phone call and he's like, turn that down.
Yeah.
Because, all of us, but growing up in the 80s, and I think it's nowadays everyone has their stereo on their ears.
Yeah.
But you'd listen.
These are two big speakers.
Yeah. So
Yeah,
that's the other
yeah.
thing you remember from when you were a kid. Talked about this morning. So,
Yeah.
okay.
Yeah.
Don't rattlesnakes.
Yeah.
Bad.
Down to business.
Down to business.
Let's see. Coming up, last night we had our first V8 meeting.
Yeah, he comes upstairs and he's like, "That was the best one ever," and he says that every time.
Well,
they just get better. Yeah.
Well, as the group kind of congeals and as the data gets more and more
and
developed.
the conversation was one of the dealers is doing some stuff with their capital,
right?
And just a really, really rich conversation around the stuff that's around capital. And
unbelievable.
Yeah,
like I just sat back, and when the conversation kind of closed up, I said, does anybody else recognize how significant that conversation was that we just had? Because you got a young dealer over there who's applying for line of credit and all the stuff that goes along with that. And wow, the conversation was amazing.
And these were our medium size. This is one of our medium sized groups, so like 100 to 500 accounts,
right?
And some of them have been in business for a very long time. They just don't want to grow a ton more than, the 500 or 300 or whatever accounts. But so it's fascinating that, when we were talking about this, you're like, yeah, I sent him the numbers the day before. And so there were that was just the stuff that they go through. It really wasn't talked about very much. It was just conversation that was, as you start to develop relationships, it's that connect part.
Yeah, for sure.
Okay.
And these dealers are getting to know each other. So that was And then other announcements we've got with that group, we've got, and I've got some material I can bring, but I would share, most folks who are tuning in recognize in the description of today's episode, we said that this is one of
a couple.
I should have said at least two.
Yeah.
Because we think in a second.
It's a rich subject.
It's a big and important subject.
Yeah.
And it's something that I really haven't seen anybody take this on in the way that I'm trying to really drill down to the numbers. And so for me, it's not about asking anybody to change what they do as much as it is putting information in front of them so they can better make a judgment as to whether or not their current policy around trade-ins and negative equity and timing of trades and all, it's a difficult one. And it's like, I just am compiling more and more information all the time. And so I want to offer today some kind of alternative ways to think about some of this stuff, or some additional ways to think about some of this. And I also had a conversation this week with Brent Carmichael, who was kind enough to give some time to contribute some education. I'm sure we'll be able to bring some clips of that. That's mostly for our V8 Plus meeting at the end of the month, but I'm sure we can share some of this. And I'll share some of what he and I talked about in that conversation this week, because it definitely relates to this subject. And I did put a poll out on the BHPH Success Group. If you haven't been in
there's been quite a few answers already.
Yeah, it looks like, and the answers are coming in so far. It looks like the numbers are about where I would expect, but it's just based on watching. But I would urge people to go over and find that. You can just do a search in the BHPH thing for poll, or you can look up one of the threads.
It should be pretty high on it, because it was you put it out there this morning. So today's topic is on negative equity and markup.
Right.
And it's, we're kind of going what's trading in, what that means, right?
Yeah. And I think obviously in our buy here, pay here space, it's got a different set of things to think about. If you think about trading the customer, like, is it is it the customer's idea to trade, or is it ours? And if the customer is asking to trade, what would be our reaction? Like, what would prevent us from trading? So I think it's all the stuff that we start to break down and think about. And so today, it's in the context of this negative equity. Well, why does the customer have negative equity at 2 years in, or even 3 years in? Like, we're seeing term of loan, and most of our groups is running around 36 months. We've got a few dealers out there at 42. There would be some in the buy here, pay here space even longer than that. But for the most part, I think most of our dealers are in that 36-month range. So you're really just talking about when can it make sense to trade, and what are the things to consider in doing that trade. And we did an episode, I should go back and find it, but this same spreadsheet that I'm going to use to kind of present some numbers this morning, I used this same spreadsheet many months ago to to do some calculations of a similar nature. And at that time I was looking at 30 months. Like I was just kind of analyzing 30 months, and I picked that. Now I'm kind of moving everything to 24 months. And so in our,
why?
Well, that's kind of come about, and I've got more studying to do, but it almost doesn't matter. Like I can pick the mark, and the lessons would be the same at 24 versus 30. It's just, I'm trying to move everything to 24 months because, one, we know the customer loses interest in their car.
Well, okay, so let's talk about human nature.
Right.
We know that our customers, they're, after a couple of years, it's like they want something new just as much as we do, or people that are in, that can go and finance at a franchise or whatever. There are, the time when everyone paid off their car, or paid cash or whatever, it's just a different landscape than it was. And there's a lot less people that actually pay off a car than, and this just in general, this is not just subprime. In general, there's less people that pay off a car than there used to be. And a lot of people and it's 2 years is kind of that's a good mark. 3 years, it's like, oh man, I'm really tired of this car. Really tired of this car. I want to do something different.
Obviously, we're leaving out those scenarios where sometimes folks' circumstances change and there's a true need to change. Like you could be, had some kids and need more room, could be had a surgery and can no longer drive a stick shift with a clutch, or whatever. There can be circumstances. So we're kind of putting those situations aside. So now we're saying the customer really just has an interest in trading. Can we make it make sense? Or could we even proactively create a program policy where we look?
You're reaching out to them at that period of time, and it's like, hey.
So I'll give you 2 quick nuggets from the conversation with Brent Carmichael, and these are things we've talked about in his appearances in the podcast before. But he said that their studies suggested, like they went back and did some studies with some of their groups, and pretty sizable, high quantity of accounts that they studied across multiple dealerships, and they found that only about 15% of the customers made it all the way to maturity and paid off their account. Okay.
Okay. Is that surprising? So that's like 1.5 people per 100 customers.
And they got quite specific.
No,
so
15% is 15, or 1.5 out of 10.
Right.
That's what I'm trying. 1.5 out of 10 will actually pay it off.
Yeah, and I just to have people have confidence, and they even went so far as to verify that the final payment was, and I think he said the final payment came in at like $250 or something. So as an average, so what that says is these are not insurance payoffs; these are customers actually making it all the way to maturity. And I don't know if you noticed this week, a shout out to Tommy Brandis and Gunner up there in Pennsylvania. I've seen their posts go out where they're presenting their customers with titles.
They do that all. I mean, I guess I pay closer attention because it is all the time that they have pictures of, or it's either titles or it's referral checks, titles and referral checks, titles and referral checks.
And as a former dealer, when I see Tommy, in one of those photos, I think he's sitting there smiling and happy for the customer, and he's like, dang it, there goes another car payment. Right?
Well, I mean, that is the nature of our business, is that
you hate to lose the customer. You want to see them be successful.
So what is and I know that he gets repeat customers. And so, someone may pay off a car, but then they bought another one, and they have this car, and there's lots of different ways but the value of keeping a customer is massive.
So
I mean, it's and for those dealers out there, because there's a lot that it's like just burning through customers. They don't understand necessarily the value, but those of you who do have, you get repeat and repeat and repeat and repeat. You understand there's a tangible value and there's an untangible value. And the tangible value is, one, you're keeping the payments coming in, and that matters.
Right.
That being able to, and the other tangible value is how much does it cost you to gain a new customer?
Mm-hmm.
That's
Right.
another tangible value.
Of
So,
course.
okay.
I'm making notes because I want to make sure and circle back to the thing about
Mhm.
Brent Carmichael, the other nugget that he
Mhm.
shared, and this is, I'm going to phrase this in the form of a question, because I
Okay.
think we're gonna let dealers answer for themselves
Okay.
as we go through these next couple of episodes on this subject, because I think that's my goal here, is not to tell dealers how they should do business. It's
Mhm.
because one of the things we both recognize about buy here, pay here, dealers love the flexibility of being able to do business the way they want to do business. What I'm trying to do is put information in front of them to help them make better judgments about the success of their business. And one of the things that Carmichael
The
said
value of
their,
some of these things.
yeah. And
Yeah.
so Brent Carmichael said, and he's said it in some of our podcast conversations in the past, is like, is the car the asset or is the customer the asset? So that's a question I want our listeners to ponder as we go
Mhm.
through a lot of this math and we think
Mhm.
through this, because there are some intangibles to think about here.
That's like a major, I'm sorry, that's a major, that's for a lot of people, it's a paradigm shift, because if you're really looking at the customer
Sure.
as your asset,
Right.
that's the asset. It's not the car.
Well,
That's
ask
the
yourself,
asset.
we've talked
What
about
a
this.
paradigm shift.
We've talked about this in the context of the Tommy conversations in the past. So like, Tommy's been a guest with us many times. For those who don't know, Tommy Brandis is, not only is he the creator of the BHPH Success Group, but he's also currently the executive director of the Mid-Atlantic region and that association up there. He is a 30 plus year dealer. He marked his 30th.
Oh, you guys have known
anniversary
each other for
20
decades.
plus years, I think. But he's a guy who's done this for a long time. And I think when I think about the asset, what is the value of a customer who's literally been, the family has been in your books for decades? What is the value of that? It's a hard thing to measure. And so it's like that deal about handing the customer the title. And so these dealers, in the survey that we put out, this poll, and again, keep taking that poll. We'll keep bringing you back to that poll, because we want to hear,
because we're going to be talking about this for a while.
And so we just barely threw it out there this morning, but it's like, I think this policy that I hear a lot of dealers talking about, how to deal with negative equity, and I've had some new awareness, I think, around this subject, and I think it's kind of, we won't go that deep into the math today, but it's kind of around this idea that when we think about, let me give you two things to ponder. Most dealers, even dealers in a 20 group, they're used to measuring something called months to breakout. Okay, so what is that? That's your cash and deal at the time of delivery, which, again, I'm always thinking about people who are brand new to the business listening to podcasts. So that's our cost in the car. And
that includes recon.
The total cost of the car minus whatever down payment we got. I typically measure it only at the time of delivery. I don't count any deferred downs or future down payment. So I'm just looking at our risk at the time of delivery. So now you take at the customer's payment, how many payments would I need to collect from the customer? This is principal and interest. Obviously, when you make your first car payment, if you go finance a car tomorrow, when you make your first car payment next month, it'll have some principal and some interest. For today, we're talking about buy here, pay here, and simple interest, but there's not much of anything that we're talking about that wouldn't also apply to other forms of interest and lease here, pay here. It's all kind of the same math. So the thing I want to plant today, just as a seed, and we'll continue to work through it, I've started creating some calculation tools, and I need to finalize those before we bring the thing to the next episode. But when we know that the finance income that we charge the customers, that any bank charges, that's to offset losses, right? So we charge interest, and that interest is really meant, because we calculate interest coverage. 20 groups to probably look at interest coverage. Certainly banks look at interest coverage. They're looking at, is the portfolio generating enough interest income to cover the net losses in the portfolio? That's what our interest is there to really do. So when you think about that in that context, and you say, okay, every payment that I collect from a customer is going to have a certain amount of interest and a certain amount of principal. Well, we know in a simple interest environment, let's focus on 24 months. In the first 24 months, the customer is going to pay a fair amount of interest, right? So that means at 24 months, they've got a high balance on principal because they've been paying mostly interest and they haven't reduced the balance. Yet that all that interest that we collected was supposed to be for losses. But if I trade the customer at 24 months, I don't experience any charge-off losses.
Well, yeah, I mean, yeah, whatever it is that would normally just fall out of the thing beforehand. But yeah.
I've got other numbers to
Uh-huh.
look at in terms of how it impacts my P&L and cash flow, and I've got those numbers to
Okay.
talk about here today. But I think what I'm really driving at is that when you think about that interest income is really meant to drive that, it's really meant to cover our losses. Then if I start to calculate months to breakout, applying only the principal, then our months to breakout is much longer, right? I mean, it just because I'm collecting, and in the example back to your $500, and to make it easy math, if your first payment on your car is $500 and $300 of that is interest and $200 of it is principal, then it stands to reason that if I'm only applying the principal to the risk, the actual cash that I have in the car, then obviously my months to breakout is much longer. I'm only applying principal. You with me so far? I want to make sure I'm losing the listeners. So I'm really just saying, put aside the interest as other income for a moment.
Okay.
The interest that I collect from the consumer, and say I'm reserving that for losses. But now this customer is sitting in front of me in 24 months and I didn't have a charge-off loss. I'm looking at trading the customer in, and I've sort of penalized that one customer. Now I realize we do this on a portfolio basis. That whole thing about interest is supposed to cover our losses. It's aggregated, right? It's in a portfolio. And so we get it. It's meant to cover the whole thing. So the interest I collect from customer 1 also helps to cover the losses of customer 3 and 4, whatever. But when I think about on this one customer base, of course, the customer's got negative equity at 24 months. I've created a scenario where they're paying mostly interest.
Yeah. You've created a scenario where, with high interest
and simple interest
that at 24 months, they're not going to have, they're still going to have quite a bit left on their loan. Because it isn't the way that simple interest works. Correct me if I'm wrong, is that towards the end of the contract is when you see the bigger amounts that start
principal starts to get reduced. That's right. So it's kind of lopsided. So of course we recognize that's part of why we have this problem in Buy Here Pay Here. And especially in 2024, I had this conversation with Brent. I was surprised to hear, here we are roughly 4 years out from what I would think of the peak of COVID. Peak of COVID was kind of that spring into summer, and when it was,
it's over,
when dealerships were shut down. But we're 4 years out. And it's like, I think about, because remember, I was concerned. I went out there on social media and said, we got a thing we got to be prepared for, because cost jumped. We still used our same method to mark up from cost. So price went way high. Either payments were going to follow and go way high, which they generally did, or term was going to get longer. Well, term gets longer. That means at 24 months, we're likely to be in an even worse negative
position.
Obviously, this all depends on the value of the car and how the market has treated the value of the used car. So there's so many layers to this to think about. But for right now, I just want to think about, of course, we've got the customer in a negative situation at 24 months. And I think, are we going to lose the customer? We did our own analysis with one of our clients who's been in business for 15, 18 years. And we were, because of software change, we were only able to study like the last 7 years or so. But it showed the same kind of thing where their success rate is pretty high, but they don't have that many customers to make it to 36 months. Even if in our case, we were only measuring the ones that were.
Well, and if your full term is around 36 months, just like what Brent said, it's like 1.5 of every 10 customers are making it. The rest of them are
correct.
Yeah.
Or getting results. So you could have it could still resolve successfully through an insurance settlement. It could be an accident. It could have been an internal trade. You trade them into another account, whatever. But it's like, so it doesn't mean the account ended badly with the other 8.5 in your example. But so certainly charge-offs and repos are going to be a big piece of that. And then you have to look at how did the customer do. But I think when we really start to look at this hard math, I think what I'm trying to present to dealers, and I guess we can show the screen here.
I'll put it up.
Or if you got it.
Yep.
And we'll try to make it, we'll try to expand it.
Yeah.
So
again, if y'all are listening
on audio
on our syndicated stations, please go to YouTube if you want to see the charts, or if you're just kind of listening to this live on Facebook or something, you're driving around, go back and look at it when you can sit at a desk and look at the charts.
Sure.
So, yeah,
And
it's helpful.
And while they're doing that, I haven't asked. Just hit that subscribe button on the YouTube
like
channel.
And subscribe.
Yeah,
like and subscribe.
Hit that
Okay.
subscribe button on the YouTube channel, because that's where you'll find so much of our stuff, right?
Yeah.
So this is now I'm going to share this other part. This whole thing is built on an amortization. I used a mortgage calculator amortization, and
I saw him working on this, and I was like, we buying a house?
Yeah.
Right now?
So this one actually amortized at the numbers I have in there. This one actually amortized out to be it's just 22% interest, but I think I need to look at the rest of this. But bottom line is what I was able to do then is take that amortization, and because it doesn't matter, I'm only amortizing based on the and I just realized I've got a problem here, Michelle. I've got something I've got to fix. So we may have to continue this to the next episode, because I didn't catch that amortization is built on a different price, and I'm not sure I can change it and have it all work right in the middle of this conversation. So I obviously don't want to present numbers that are incorrect, but let me just kind of present the idea and the layout, because this part would be relevant. What I'm looking at and the methodology that I'm using here is to basically say, and let's kind of keep this 30-month part hidden for now, because that was the old data. I just kept this so that we'd have these labels over here on the right side as to what you're seeing. So I hid a bunch of columns. You can see right here, it jumps from month 3 to month 21 so that we can have it all kind of on the same screen. But I'm basically taking an amortization, and I'm saying, okay, if the customer came to trade us at the 24-month mark,
what does that look like?
We can pick whatever the value, like the yellow cells are the ones that I can plug in and change. So over here, I've got some structure that says, that's the part I changed at the last minute, not realizing the other part wasn't going to follow, is that the selling price, $13,900. I've got an inventory cost of $8,000, which results in a gross profit of $5,900. I've got some add-ons to be financed that obviously affects the amortization and then the down payment. So that's going to let us get to an amount financed. And so that needs to drive these numbers. And it does look like actually this amortization is using that number from my calculations here. So we may be okay. But I think for today, we'll just, until I get a chance to reconfirm everything, we'll just kind of focus on the method that I'm using. So I'm basically looking at, now, if my car was $8,000 cost at the time that I financed it originally, then obviously we can all pick a number as to what we think that car would be worth at 24 months out wholesale. And so I picked $5,500 at 24 months. I'm just, anybody could guess it. And we could use some methodology in the future to arrive at better numbers. But what it does now, it says, okay, in that 24 months, here's the interest that I would have earned. Okay. So again, that kind of illustrates why, that it's kind of problematic in terms of where we're at. We've collected $5,500 of profit. I mean, there's just no other way to look at interest collected. It's profit to you. Okay. And it's the right kind of profit, because we only experience that income as we collect it, unlike the gross profit markup on the car, where we're going to get taxed income wise. We're going to experience tax on that. I would also say, even though it's a much smaller number, every dollar that we increase our gross profit and our selling price also moves our sales tax. So, while that's a pretty negligible number,
most states it's up front.
Yeah. So you're paying more income tax because I'm charging more gross profit on the car, and I'm paying more sales tax on the front end. And so we didn't go into a lot of detail there, but I'm just simply saying, at this point, we've collected $5,500 of interest income from the customer. And I think it's worth noting, back to what I said, that I'm not going to experience a charge-off with this customer if I trade them today. And so that interest that I earned, that I had anticipated setting aside for future losses, with this customer, I don't experience it. So I need to kind of factor that in, I think, in my thinking. Now, the customer's payoff is $7,900. So if I give them a trade allowance of the same number, just to kind of keep the math simple, and say I give them a trade for the same amount, and what happens with the write-off, I deal with that in terms of how it affects our balance sheet and P&L. So now the impact to the cash flow, what it means is I now have to go replace my $8,000 car, to go put another $8,000 car on the front line, right? And I liquidate the trade. I just run it to an auction or sell it to a wholesaler, and it's worth $5,500. So I bring in a positive $5,500. I bring in a new down payment. This assumes a new down payment from the customer. I've got a $1,500 number in there. And I do think there are a couple things I just barely made some last minute notes over here. I want jump and say, other considerations here is that in this scenario, I would say the customer needs to bear responsibility. So think of it like a lease. Obviously, if in a lease scenario, it's written in a language that the customer would bear, if it's a missing a fender and it needs $800 worth of body work, that's on the customer. Customer is responsible for the depreciation. Okay. So this assumes the car's in good shape. It doesn't require any additional work. And now we trade it in like that. So now we get a down payment. And now the dealer's got the funding of the TT&L. So to trade with that customer today from a pure cash perspective, did I leave anything out? Can you think of something else that's going to be an impact to the dealer? So from a pure cash perspective, after I replace the car, I'm negative $1,000. It's taken me $1,000 cash to do the deal today is another way to think about it. Okay. Now the impact to the profit and loss. I have profit on the new sale, $5,900. Okay. I have an internal write-off of the trade. Okay, so I'm double checking that number. I've got a trade allowance of $7,900. That account balance is still there, so I've got to write that gross account balance off. After the customer leaves, the acquiring the trade and the interest that I've earned in the deal is like there's no impact to the P&L that day. So the change of inventory doesn't impact the P&L. Those things do impact the balance sheet, which says, okay, what happens to the balance sheet? My receivables go up by 13, new sale, right? New receivables. My receivables go down from the trade write-off. I write off the $7,900 account balance. And then I've got a plus cash or plus impact to the balance sheet of the cash account from selling the trade. Okay. So it's either represented on the balance sheet as inventory, or if I just sell it immediately, then it's cash. And now I've got the negative $8,000 to replace the new the other car, which impacts my cash account, which affects my balance sheet. So now I'm at $2,721 gain on my balance sheet. So I think that's important. I didn't really get into the equity piece. I mean, I think that's another element we could look at, but I'm just saying I went negative $1,000. My balance sheet went up $2,700. Okay. And now my projected income, the last piece that I have in here, and there are other pieces, I would invite feedback from anybody listening. If you think of other things that you would like to see in these calculations that you feel like are a consideration, please let me know. But I just said, if I don't trade with this customer and their account balance stays where it is, then the anticipated interest income from that customer over the next
2 years or
is 12 months. Actually, is all I calculated. It's just if I just let that customer keep paying and they move toward the end of the note, I would collect another $1,800 of interest. But if I trade them in, then I'm resetting the clock, so to speak. I'm resetting their account balance, and they're still paying the same payment. We didn't dig too deep into any of that, but this assumes they basically just trade and keep the $1,500 down and keep the same payment. So now I would have $3,100 almost of interest income if I do the trade. So I think it's just, this is.
You mean not from the new car, but from the old car in total?
No, I'm just saying because there's a new account, the account balance goes up instead of having an account balance customer. If I didn't trade, the customer would leave the building today with a $7,900 account balance, which is only going to drive so much income in the next 12 months. But if I trade them, their account balance goes back up to 13 grand. And so now my interest income goes up, right? Across because of the account balance. So that's kind of the part I was trying to break down. And so I think now when we put this information in front of dealers, I just want them to be aware and think about the impact, because you touched on some of the intangibles. And I think for me, another question that I asked Brent Carmichael, which by the way, I'm grateful to Steve Burke at Agora is going to be with me on Monday. And we're going to ask basically the same questions of Steve that I asked of Brent. And, Steve's a guy who's had a long career, and especially as a finance company, he's more, his more, and we'll talk about it, but I think his career has been more in the finance company side, acquiring paper and running portfolios, than it has been in the dealership side. I think he's done both, but certainly he would understand the mathematics here, because it's all part of what we're doing. But one of the things that I talked about with Brent that I look forward to asking Steve as well is I asked him, look, if you were opening a dealership tomorrow that was a lease here, pay here dealership, where would you be setting your term? So I would ask the same thing of you. You've heard me talk about some of this kind of stuff, and we've obviously had conversations with LHPH Capital. I love some of my past conversations with Trevor, and I look forward to many more. But I wonder if you can guess what Brent's answer was.
24 months.
Yeah. He said 24
Yeah.
months. So I think, and this was without any, I didn't
Mhm.
feed him anything, right? I just
That
asked
that
him.
was just from what he understands about the industry, lease here, pay here, the data that he's been collecting for a long time. It's like that's where you set the thing. It's
Yeah, I
24
don't
months.
remember. I think he gave multiple reasons, and
Mhm.
I don't remember exactly. But I followed up with why, like why 24 months. You know, for him it was really between 36 and 24 months, and I remember that one of the things he said was the same thing I was sitting there thinking, because I would be doing the same, and I've said the same to others, and I probably said it to the folks at LHPH. It's like, I if I'm the dealer, and I did this, by the way, with a dealership in Tennessee. I managed a dealership in Tennessee, lived in Texas and back and forth to Tennessee a lot with a
Mhm.
dealership that we were doing about 40 a month and lease here, pay here. And so it was a good education for me. I think we've covered that story in the past, but
Mhm.
it was a total restructure of the thing,
Mhm.
and it was really successful to kind of turn around with them. But they were doing pretty good volume of lease here, pay here, and we did a 24-month lease with a 24-month warranty. And so what it does is it allows the customer
Yeah.
to, you think about it, from the pure dealership standpoint. Let me just
Mhm.
be the dealer for a minute.
Yeah.
What I love about that scenario is, in 24 months, I get to have a conversation with the customer. We start to mail them. We start to reach out to them and say,
Mhm.
hey, your residual is coming due. It's time for us to meet and talk about what you want to do. And so if I get to sit with that customer, I say, and I'm proactive about it. It's my idea, not the customer's idea to trade.
Mhm.
And so I get to meet with them and say, hey, what's your situation like? I mean, are you happy with the car? Do you want to keep it? What do you feel like you want to do? And I know I'm sitting over here in the back of my mind. I don't ever find it necessary to say this to a customer, but in the back of my mind, I'm saying to them, I'm saying to myself, and trying to, you know, feed it into the conversation where I can, is that you probably don't want to own this car. It's going to be worth less in 2 years. This
Mhm.
asset is going to be worth less in 2 years than it is now. And so you decide what you want to do. But I know that for them, they're going to put ownership into an asset of something's going to be worth a lot less. It's going to
Mhm.
depreciate. Now, it's up to them to make the
Mhm.
judgment, but I'm simply saying, not sure you really want to own this
Yeah.
car.
I mean, that's like a whole nother topic, but a lot of very smart business people, it's like rent what depreciates, own what appreciates.
Mhm.
That's
Yeah. So that's
that's a smart money management
right.
way of looking at
Right.
what you're putting big
Yeah.
chunks of money into.
Yeah. And forgive
Mhm.
me, I always get emotional when we talk about leasing. I have just a weepy eye. It leaks once in a while. That's enough ugliness for today. But anyway, I think it's an important element to
Uh-huh.
consider when when I'm approaching the customer.
Mhm.
I'm simply saying, and this is all math I can run through in my head, but it's almost like the account balance would be similar, and the ratios would be similar in terms of where the customer account started, where it is today, and what is the anticipated future value of that car that they're driving.
Mhm.
And is the customer the asset or the car? Like, is it, do we
Mhm.
want, and do we really want that car as the asset? I mean, it's going to be worth less in a year or 2 years than it is now. And so,
Well, and like I said, paradigm shift, because we hear from and of dealers that they look at a car as I can put three different butts in that seat,
right.
and so I'll repo it, resell it again, repo it, and so that asset, the car,
Yeah.
is worth X amount of dollars,
Yeah.
but they're burning through customers.
I
And
so want to get off into the repo conversation around that, but
mhm,
I think for today we're better off to keep away from that one and just
mhm.
think about the trade scenario, because there is some elements to the repo side that factors into what we're talking about here. But I think what we really have to ask ourselves is the customer the asset? And if the customer is the asset, then what is it worth to keep them
Yep.
and make them happy and keep them under warranty? Why do we do a warranty? Is it to help us or help the
Well,
customer? It's
and we've
both,
had a
right?
conversation about that or yesterday and days before, where it's like, you have your warranty and you have your service contract, and and to get someone to that 24 months,
Mhm.
and having the customer is the asset, but having something that can trade in and keep this whole machine going,
Right.
you have a higher probability of having something that can trade in, that has it's in better condition, you
Mhm.
know, that all of that, if you support and you have a better chance of keeping a happy customer because they know they're supported in all of the stuff. Because most people, yeah, and I know this is true for us, because when we've bought cars, we buy the service contract. And why? Because we've had transmissions replaced.
Mhm.
And without us having to come up with an exorbitant amount of dollars.
Mhm.
And I don't care if you are buying something off of a franchise lot or if you're buying something at a buy here, pay here, everyone knows that cars break down.
Mhm. And I
So,
think what the reinsurance folks would say, and it's absolutely true. Um, I'm either going to offer the customer service contract, which is going to bump their payment a little bit. They're going
mhm,
to have the payment responsibility. Obviously, I could choose not to and put it all at the end. That's my
mhm,
discretion as a dealer. But most dealers are going to charge the customer a payment for a service contract, or I'm going to provide a warranty, which is included in my price. The
mhm,
customer doesn't pay any extra. So those are two ways that I can support the customer. They can buy that, or I can include it. Obviously, if I'm including it, my price is going to reflect that. I have to allow for
mhm.
that in my financial structure, or I can loan the customer money. Okay, so in that case, it's coming out of my cash, or I can do goodwill repairs. It's all coming out of my
That
bank
was
account.
actually stuff that we were talking about,
Sure.
is because we were discussing one of our clients that
Mhm.
they do a lot of goodwill repairs. They
Sure.
don't have the service contract thing, and it's like, that it financially makes sense to do the service contract, get them to understand the importance of that. And it's, a minimal amount every month that they're
Mhm.
going to be paying. But then that supports them. That money's going into an account, and um, there's no more goodwill repairs.
Right. So that's a whole different conversation
Yeah.
I want to save for later, because I think the piece that we're touching on, I think, is
Hmm.
significant. Like, again, focusing on 24 months.
Hmm.
If I protect the customer,
Hmm.
or I support the customer over 24 months, I could do a warranty. I could do a service contract. I could do side loans for them. I
Hmm.
could do goodwill repairs and pay for it out of my pocket. Or I could do nothing and pay for it in terms of degraded collateral.
Or just a repo because
That's what I'm
they
saying.
stop paying.
That's what I'm
Yeah.
saying. They stop
They,
paying, so I
mm-hmm,
pay for it now, because what? I didn't support the collateral. So now I get
mm-hmm,
the collateral back at a much degraded
mm-hmm,
value. I'm writing off a large balance on the
mm-hmm,
customer's account because I did nothing to support the customer. So there's obviously a goodwill customer service element to the reinsurance side. And
mm-hmm,
we're certainly advocates for reinsurance. We see dealers build a lot of wealth. And I think I mentioned in my last episode, and after I recently extended with one of our clients, the cash flows projections from 5 to 10 years,
mm-hmm.
the wealth creation in reinsurance is substantial. So it's certainly something we're advocates of. We
Mm-hmm.
believe dealers should have a hard look
Well,
at.
it's not just for the wealth side, but it's because it is supporting your customer. I mean,
So the
it's the
customer
wealth
service
is
side.
a straight line reason why, but
Sure.
the reinsurance it supports the customer. So
Yeah.
customer success
Yeah.
can equate to long-term customers, repeat customers,
Yeah.
and people that feel like this is where you want to go
Yeah.
because they, you really
Yeah.
I had a problem and it got solved. I
Sure.
had another problem and it got solved.
Right.
And
Yeah.
yeah.
So another thing that happened in our V8 meeting last night, and this is where I think reinsurance people would pay a lot of money to have this information, because we had dealers on a screen in a
Hmm.
virtual meeting, and you had some saying, here's why I chose to do reinsurance. Here's why I chose not to do reinsurance. Like, these are established dealers, right?
Hmm.
And so we don't have to go into the reasons, but it's like, it was really fascinating to watch them talk through. Here's why I like it. Here's why I don't do it, and so on. Or
Hmm.
we tried it, and now we only do CPI or whatever. So it's like, everybody's got their different business models.
Hmm.
That's one of the things you and I are going to, if we do this business for 20 years, we're going to still see dealers being all different kind of business models and business
Hmm.
approaches. That's just the reality of buy here, pay here. You'll never have consistency in terms of, a business approach. And that's okay. I'm fine with it, I think. But what I want to do is continue to do this and bring information to dealers, because I think it's a missed opportunity, is kind of what I would say, is that when we aren't familiar enough with the numbers and we don't really look at the whole picture, then I think we're missing an opportunity to be proactive. And I
Hmm.
think we're helping ourselves too, just like this scenario. If I can if I can trade that customer at 24 months, dealers are sitting over there thinking, well, no, the negative equity, the write-off, I got the write-off. I don't want to deal with the negative equity. Well, you're missing the idea that you're also going to be acquiring a trade that's in good condition. You've got a car that's now, they put some miles on it. And I didn't say, but the consumer really also needs to, suffer the miles, and they would in this scenario because the car would be depreciated more. And so it would be reduced. And so they would be, dealing with that. So there's another element to this that we can cover in the future, which is the rolling the balance. Dealers talk about, should I roll the balance into the next deal? And I think what we're really suggesting here is
what you ran here is, no, you're not writing, they're rolling the balance in.
I'm absorbing it. And part of what I'm saying is I think dealers are in a much better position to remarket that trade and absorb the negative equity, because they're gonna keep the customer, and they're gonna keep the cash flow, and they're gonna have financial motivations, and so a lot of times they may benefit from getting that trade in. It's just, think about the difference in that trade in value, because what mileage range are our dealers financing in? They're 120,000 miles or something, and so now what's that car worth in 2 years? What's that car worth in 3 years? And wouldn't we rather have it back at a time that it doesn't require any work? It just needs a cleanup and maybe some fresh spark plugs or whatever. And do they even use spark plugs in cars anymore? I don't even know. But I'm so out of touch on the mechanical side. But it's like that. But the point is that I'm getting the car back, and I'm recovering some strong collateral and something that I can liquidate and I can remarket, wholesale or retail. So I just think it's something that for today, it was about just starting the conversation, laying out some numbers to think about. And I look forward to bringing back more of this information about, when we start to think about that interest income as going against losses, and now we don't have those losses with this particular customer, then we can say there's negative equity. Yeah, but we've already enjoyed a lot of income over here that we don't have to use toward our loss bucket. And so we just got to start to think about the whole picture. And so this is all I'm trying to introduce to dealers. And we're talking about some of those things, obviously, through our V8 groups, and want to have a chance to just, start the dialogue. And we're just talking about numbers over here and throwing in a couple of intangibles to think about.
And I'm going to get on my soapbox for just a second. Right. If the collateral or the collateral car or the customer, if the customer is your collateral
or your asset,
sorry, if your customer is your asset, not the car is your asset, how are you marketing?
Good point. Yeah, we're out there selling cars a lot. So Michelle's stepping
you'd want to sell human solutions. Yeah. It's like, because everyone needs a car, and everyone has problems with their car, and we can help you.
Right.
We can support you through the entire process. And just so what is it? What's your focus on marketing? Is it the car because that's the asset, or is it the customer because that's the asset?
Yeah. And did we do that poll? I can't remember where we did that poll, but I asked that question basically, and dealers were pretty much coming back and saying that they promote the program. Oh, I know. It was in our survey that we did, which, by the way, that's due to be updated. I need to get that out to some more dealers, because it's Monday that we're going to announce bring the results from that survey that we did. So there was a 10-question survey around marketing. And so that was one of the questions. So we'll be able to bring back the results and talk about that.
What else?
I don't know that I've got anything else. So I want to wish everybody a happy weekend.
It is Friday. Yeah, I think we're going to try to do a hike again.
She's going to drag me on another hike.
I am, but maybe we won't do something that has like a 1,200 elevation that we climb.
I'm going to start preloading ibuprofen now.
I'm trying to keep his heart healthy, so he can be around, so that you can be around for me and all of you. I'm not selfish.
I was just trying to get to the top of the mountain last time, so it'd be a good spot for them to medevac flight me out.
Yeah, well, and it was flat. We should just try to do the top of something. Thanks so much for joining us, everybody. Again, if you want to take a peek at some of the things that we shared on the screen, go to our YouTube channel and like and subscribe. And we hope you guys have a great weekend, and we will see you on Monday. Thanks so much again for joining, everybody.